Welcome back to Grufity, where we discover the joy of investing. Today, we're telling one of the wildest comeback stories in the entire stock market. This is the story of Carvana. In 2022, Carvana stock fell about 98%. Analysts called it a zombie, all but certain to go bankrupt. Then something crazy happened. It came roaring back to life. First, what does Carvana actually do? It sells used cars entirely online, no dealership, no haggling. You buy from your couch and they deliver the car to your door. Or you pick it up from one of those giant glass car vending machines. During the pandemic boom, Carvana grew like crazy, but it did it by piling on debt and buying inventory it couldn't sell. Then used car prices crashed and interest rates spiked. Suddenly, all that debt turned into a ticking bomb. So how did they survive? Management got ruthless. They cut costs to the bone, restructured billions in debt with lenders, and obsessed over profit per car instead of just chasing growth. The goal flipped from get big to make money. And the numbers tell the tale. Revenue is back to over $22 billion in the trailing 12 months, growing more than 51% year over year. This is not a company quietly fading away. It's a business back on the attack. But here's the real shocker. For years, Carvana lost money on almost every car. Now look, net income has swung to a positive $1.5 billion, up an eye-watering 273% from a year ago. The zombie learned to make money. Even the cash flow, the thing that nearly killed them, has healed. Free cash flow is now positive at around $740 million over the last year. When you're generating real cash, your creditors stop circling like vultures. The rebuilt engine looks genuinely strong. Return on equity is a punchy 40%. Operating cash flow easily covers the interest bill more than 3 times over. And the current ratio above 4 means plenty of short-term cushion. This is a very different company than the one on death's door. For anyone who bought near the bottom, this has been life-changing. The stock is up over 150% in 3 years. But before you chase it, remember why it crashed the first time. This ride is anything but smooth. Because the risks haven't vanished. Debt is still higher than equity. The stock has fallen more than 30% in a single stretch 4 out of the last 5 years. And it lives and dies with used car prices and interest rates. This is a comeback, not a coronation. So here's the scorecard. The turnaround is real. Profits and cash flow are genuinely impressive, but the balance sheet and volatility keep this firmly in high-risk territory. Carvana came back from the dead. The question is whether it can stay alive. If you enjoyed this deep dive, you know what to do. Hit subscribe for more stories like this and keep discovering the joy of investing with Grufity.